I want you to imagine it's 1999. The world has fallen in love with the internet. Share prices double in months. New millionaires appear overnight. And everywhere you turn, someone whispers the same four words. This time is different. You buy the story, you buy the stocks. For a while, you look like a genius until 2000 reminds everyone that gravity exists. The party ends, the market takes the elevator down. The lesson is brutal but clear. Technology can be revolutionary and still become a bubble. Fast forward to today, that same electricity is back in the air. Only now it has two letters, AI. Pre-profit companies with big promises, overextended valuations based on future profits, and investors who feel like they've seen the future early. Maybe they have, maybe you have, but when I look at the data, I can't help but feel a sense of deja vu. In this video, I want to show you the pattern that connects today's AI boom to the dot-com bubble, to crypto euphoria, even to mania centuries old. And later, we'll dive into a psychology study that explains why bubbles keep repeating. And by the end, you know how to spot the danger signs and how not to become a casualty of the next bubble. According to a recent report, the forward 12-month price-to-earnings ratio of the S&P 500 stood at 23.1 on October 29, 2025. That's well above the 25-year average of 16.3. Before this recent rally, the last time we saw a PE above 23 was in September 2020, when the market was still buzzing from the post-COVID boom, and the index hasn't traded much higher than it is now since March 2000, when its forward PE peaked at 26.2 right before the dot-com bubble began to deflate and sent the S&P 500 crashing 49% by October 2002. When you break it down by sector, 10 of the 11 sectors in the S&P 500 are trading above their long-term averages. The biggest outlier is information technology, with a forward PE of 32 compared to its 25-year average of 20.3. So basically, investors are paying over 30 times next year's expected earnings for tech stocks, driven by the belief that AI will transform everything. And these tech giants, mainly the Magnificent Seven, now dominate most index funds. Together, they now account for nearly 40% of the entire S&P 500. It just shows how deeply every investor is tied to the AI wave, even if you don't own any of these companies directly. If this all plays out perfectly, everyone wins. But if it doesn't, everyone feels the pain. Now, there's no question AI is changing the world. It's not just hype, it's real innovation. We're seeing breakthroughs in medicine, energy, software, and automation. But here's where things get tricky. The stock market isn't pricing in potential anymore. It's pricing in perfection. And that's where I start to get cautious, because we've been here before. The same optimism that drove the dot-com boom and the crypto rush is back, just with a new story. Back then, investors were chasing the internet. Now, it's artificial intelligence. Different technology, same psychology. And that brings me to something interesting I came across recently. A psychology study that might explain why this keeps happening. It's titled Narcissism and Stock Market Investing: Correlates and Consequences of Cocksure Investing. The researchers, Foster, Rady, Misra, and Goff, wanted to understand why some investors are drawn to risky stocks, even when caution would make more sense. They found something fascinating. People with higher narcissistic traits, overconfidence, competitiveness, and a desire for recognition tend to pick riskier stocks, hold on to them longer, and believe they'll outsmart the markets. Not because they misunderstood danger, but because they liked it. It promised glory. Their portfolios ended up full of volatile, high beta stocks, and their returns were consistently worse. The problem wasn't confidence, it was confidence without caution. That feeling of invisibility right before reality catches up. And that's exactly what I see happening right now. And at the center, one constant: overconfidence. The belief that we won't be the bag holder, that we'll sell at the top, that we are the exception. The language has changed, but the psychology hasn't. In 1999, it was the internet would change everything. In 2021, it was crypto will replace banks. And in 2025, it's AI will run the world. Maybe it will, but none of that guarantees the stocks tied to those stories will live up to the hype. No one is asking harder questions like, if growth slows, what's left? If compute costs rise, who has pricing power? If the hype cools, where do the multiples land? That's why every bubble feels the same. It's not just prices going up, it's the frenzy that builds around them. The higher it rises, the harder it gets to stay rational. That's exactly what happened during the dot-com bubble. No one expected the crash when it came. The first warning signs were when big players like Dell and Cisco started selling their own shares. That insider selling triggered panic. and within 2 years, the Nasdaq fell nearly 80%, and most .coms disappeared overnight once the funding dried up. The same pattern repeated during the NFT and crypto bubble of 2021. Speculation drove the total crypto market value above $3 trillion until central banks started tightening monetary policy. Then almost overnight, the air came out. And I think something similar could happen again. No one knows when this AI frenzy will cool off, but the moment you start seeing aggressive insider selling, that might be the first warning sign. It might still take time. Remember, the .com bubble took years to inflate before it finally burst. Now, I'm not saying AI isn't real. It is. The technology is incredible. But what worries me is the certainty in the air. The belief that missing out on this wave means missing out on the future. So, what do we take from all of this? First, separate story from stock. Look at balance sheets, customer concentration, and competition. Next, diversify. If you want to bet on AI's upside, do it rationally. Own the critical parts of the value chain. Prefer cash generators to cash consumers. Expect multiple compression when the story cools. Let price dictate position size, not the other way around. And finally, decide what you will not do. No chasing parabolic moves. No doubling down to prove you were right. And if a decade from now, AI truly has reshaped everything, the companies that survived won't be the ones shouting the loudest. They'll be the ones that executed quietly, stayed profitable, and ignored the hype cycle. The same overconfidence that powered the .com boom, the NFT and crypto craze, and the housing bubble is what's driving markets right now. The researchers called it cocksure investing. I call it the cost of certainty, that mix of greed and optimism that makes us believe this time is different. But is it?